Happy Friday, traders. This is Fawad Razakzala, market analyst for City Index. Today is the 4th of October. Earlier, we saw the release of the jobs report, and as you can see from these figures, it was a very strong jobs report indeed. The headline data showed 254,000 net job gains in September compared to 147 expected. We also saw the average hourly earnings come in at 0.4% month over month, or 4% year over year. The unemployment rate fell as well, and we saw positive revisions for the prior 2 months data. The data certainly complicates the Fed's task a little bit. Earlier this week, remember, the Fed chair, Powell, had dismissed talks of another 50 basis point rate cut. And judging by today's jobs report, you can't really argue with that. So going forward, the Fed is likely to proceed with 25 basis point rate cuts at its next 2 meetings. And indeed, that's what the markets are pricing in right now. As you can see from the CME FedWatch tool, the probability of a 50 basis point rate cut at the Fed's next meeting on 7th of November has fallen drastically to just over 5% after being about 50% just a week ago. And likewise, the probability of a 50 basis point cut at the subsequent meeting has also fallen sharply, as you can see here. So the Fed is fully expected to cut rates by at least 50 basis points in total for this year, meaning 2 25 basis point rate cuts. And if incoming data continues to show strength for the labor market, then that may raise some questions over the December's meeting. But as things stand, the market is still fully pricing into more rate cuts from the Fed. Now, the initial market response was a positive one. The major stock indices all rallied. The S&P 500 broke yesterday's high. But it's now coming off its earlier highs, suggesting that investors are perhaps concerned to hold on to their bullish trades ahead of the weekend, given the ongoing situation in the Middle East. With the risk of further escalation in that region, we could see markets gap at the Asian Open should something happen at the weekend. So we are seeing equity indices coming off their earlier highs. It's not a completely reversal yet. We are still holding above a major support zone on the S&P 500, which is this blue shaded region, where previously the index had found resistance on a couple of occasions or a few occasions before breaking out in the latter parts of September. We are still holding above that area, and so long as this support area holds, the part of least resistance remains to the upside. But given the upcoming US elections, the raised geopolitical risks, and uncertainty now over the Fed's future rate decisions, and also company earnings results are going to start soon, ahead of all of that, we could potentially see the market pull back a little bit. And if this bullish trend line breaks down and we go below this key support zone, that could potentially trigger a bit of a risk off trade, and we could see some follow-up technical selling below these levels should we get there. In the FX space, the markets have reacted swiftly. The dollar is high across the board, led by the dollar-yen pair, which kind of makes sense. If you recall, earlier this week, the Japanese Prime Minister said that the level of interest rates in Japan were appropriate and that the central bank didn't need to raise interest rates any further. That caused the yen to slump across the board. And today's data from the US has been strong, so the dollar yen is naturally going up. But will this rally continue if the equity markets were to turn around? That's the big question. And so far, it looks like the bulls want to keep this currency pair bid. But if we go back below the shaded region, let's color that in gray now. If you go back below this area, I think that would be a bearish reversal pattern. But in that scenario, it would make more sense to potentially look for short setups in some other yen pairs, for example, the euro yen or the pound yen, as opposed to the dollar yen, because this is supported not only because of strong data, but we've seen raised geopolitical tensions in the Middle East causing the dollar to rise across the board. Indeed, if you look at the euro dollar, it has broken this key support area I had highlighted previously at around the 110 handle. A daily close below this area could potentially pave the way for further losses in the days ahead, with the potential for rates to drop to around 109 or slightly below, where we have the 200-day moving average converging with prior support and resistance area. Next week, the markets are going to focus on US inflation data in midweek. We'll also have a decision from RB&Z in terms of interest rates, and along with a few other economic reports. And for more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. Have a lovely weekend.